Well, happy Monday to you. Thank you for joining us today. I'm Marlon Bowling with you, your tour guide to the ag commodities. And who is a better tour guide assistant to open up a Monday than Brian Hoops, president of Midwest Market Solutions? He joins us from Springfield, Missouri this morning. Wow, you're looking all bright and shiny this morning. So as we kick off our final trading week, it's not even quite a full trading week in November, but we're going to be heading toward the end of the month here. Do you expect much to happen in the ag trade?
Well, I think we'll see quite a bit of positioning, Marlon, and good morning. You know, over the weekend, rains did fall in Brazil, maybe a little bit lighter than expected in northern Brazil, but forecast is kind of a change of that pattern for most of the country, back to maybe more of a normal pattern, a little bit wetter. And we've seen soybeans erase all of last week's gains. In fact, overnight, they took out last week's lows. So we're giving back a lot of these gains. The corn market is hovering on contract lows. We have deliveries starting this week for December futures, so any long positions are subject to those deliveries. We could see fairly heavy deliveries of corn and wheat, I'm afraid. And typically when that happens, you see a little weakness going into that delivery period and then a rally following it as the market absorbs those deliveries. So I don't think we'll be making any early week lows, maybe midweek lows, then trying to rally. The wheat market, I actually was in Colorado over the weekend and drove back through a lot of that snow that happened in the winter wheat belt. And the winter wheat has really been blessed with some good snows over the weekend. The crop on Sunday, sun was coming out and the snow was melting already. And boy, that winter wheat looked really green and really nice. And it will probably grow for another week or two because temperatures will be in the 50s. And that crop hasn't gone into dormancy yet. So that crop is going to be off to, a really good start compared to what it has been the last couple years. And that's probably going to keep some pressure against that wheat market as, we're still trying to find that price level where we can stimulate some demand for our winter wheat crop that we just can't get rid of.
Yeah, that's just to help that market needs, right?
It's going to keep us near these contract lows, I'm afraid, for some time. And maybe that's the thing that we need to find that price level that'll finally stimulate demand where we can see a rally in the wheat futures. Otherwise, it's going to be a long winter, I'm afraid.
Well, let's walk through our market prices from last night then. We'll take a look at the Globex trade. Our quotes from bar chart show we ended up with December corn down 2 at 461 1/4. So as you say, just kind of weak and not much enthusiasm there. And in soybeans, you talk about a boring close. Wow, January soybeans 0.75 cent higher at 13.31 1/2. That was about 7.5 cents off of its overnight high there. And in Chicago December wheat, we were down just a penny at 5.47 3/4. By the way, I was going to ask you on these December contracts, are you now looking more at, for example, the March contracts on corn and wheat now or not?
Yeah, you should be because you can't really trade from the long side after this week anyway. So, producers, maybe the elevators maybe haven't rolled yet to a different month. But, if you're, trying to re-own your crop or trying to speculate in this market, get away from the December, move to another month, maybe March or July, May, July, those type of contracts.
All right, that's a great point. Okay, let's look at Kansas City then and see what that market did overnight. Here you had all right, we'll go with the March. It was 2.5 cents higher at 6.14 as we wrapped the overnight trade up. We were a couple of pennies from the low of the overnight trade, off our high by about 3.5 cents last night. Minneapolis spring wheat trade, again, we'll look at the March. It was up 3/4 at 7.15 1/4. Anything going on in the cotton market? Now, on cotton, I still like to favor the December just because that's by far the most popular contract. It's up 3 points. But the March is down 162 points. So, yeah, I mean, man, it kind of took it in the shorts on that March contract there. 79.38 is the last trade here this morning on that. As far as the crude oil market goes, we have been watching that, of course. West Texas Intermediate crude down again, 31 cents lower at 75.23. This is something that does bear watching because of, we had more hostilities in the Middle East, and we had, one or two more ships taken, I guess you would say, pirated away by Yemeni forces, and then the U.S. apparently took one of them back again. So things are really getting spiraled up here in this Middle East situation, and that could lead to some crazy things happening if everything busts loose here, couldn't it?
Well, it could. I don't know that it will. I mean, your markets kind of have become numb to it. You look at what's happening with crude or even wheat on these hostilities. Markets are not really reacting to it. I think if you had major oil-producing countries become involved, like Iran or someone like that, things would change considerably. Right now, markets may be more focused in on near-term fundamentals, softening demand for U.S. products, energy prices overall start. They normally do lag as we get into the winter months, and then there's less driving. So that's what the market is really been focused on at this point, rather than what's happening overseas, because we're still producing massive amounts of crude oil here and abroad.
Okay, and let's look at what the dollar value is doing this morning on the U.S. dollar index here so far. Not much. We're down 74 points. We're at 103.230, basically steady with what we had last Friday. All right, we'll come back, and Brian, we'll talk about our livestock trade on the other side. This ought to be interesting. We'll discuss when we come back. All right, now we're back talking with Brian Hoops of Midwest Market Solutions. And I'm going to drag him kicking and screaming into this livestock discussion here. We'll talk about what to expect today. Brian, let me revisit our trade from last Friday. We have to do it. Here we go. Let's look at live cattle first on the quotes from bar chart. All right, December live cattle were down $4.22 Friday. You had February down $4.30 at $170.97. Okay, let's look at feeders. How did they finish Friday? Deep breath. January down $7.80 Friday at $219.32. Wow, that was within 20 cents of its low of the range. Look at that range last Friday, over $8 wide. Yikes. On the lean hogs on Friday, here you had the February contract down $3 and a nickel at 68.77. That was painful to read there, Brian. Did they do enough damage last week, or could there be even more in the works yet?
Okay, good question. So one thing we have to keep in mind in this futures is Friday was a abbreviated session, and it was a very low volume session. It's the day after Thanksgiving. A lot of people just historically have taken Friday off and not even shown up. So we knew that going into it, your moves were going to be exaggerated, and I think they certainly were in the case of hogs and cattle and feeder cattle. So sharply discounted. Now, that is going to produce a lot of margin call type selling, I think, today. We may open steady to higher. If we see a small rally, I think that gets sold right away, and we get pressured again this morning, just because, if you're carrying a margin call, you may not want to fund it. You may want to just get out of positions. I think that's very realistic that that'll happen today. But we're also hugely discounted to the cash markets in both the live cattle, your discount to the index in the feeder cattle futures. I mean, big discounts here, $5, $6, $8 or more. That should offer us a little bit of support going forward as we kind of get back to more normal type patterns in here and get away from this holiday. We start looking back more at cash trade, which was a couple dollars softer last week in the country. Packer margins, which are rapidly improving. They're only about negative $16 ahead instead of $90 ahead. So there's some positives in this cattle market, but it's not going to be something I think that turns us around right away. It's going to be kind of that slow process, trying to forge a bottom in the market, because we've had so much technical damage and such rampant heavy funds type selling.
But the question is why? Why are they at such a discount? How did they even get there?
Yeah. Well, a lot of it has to do with what we talk about with the funds building long positions in these markets all spring, going into the summer, into the early stages of fall. They were buying every dip. Every rally was cheered because we were at contract highs, and all of a sudden you've got this real big balloon type of large funds sitting there in a long position, and when that air comes out of that balloon, they get out of those positions, and it's a dramatic drop. And we've seen just the old adage is the staircase up, elevator down. Exactly what we've seen is just the market just has crashed here on that massive fund selling.
Okay, Brian, well, thanks for helping us get started here today. We'll get the market underway in about 5 minutes. Appreciate the help. Brian Hoops of Midwest Market Solutions with us here on a Monday morning.